and welcome to Money Control. Well, we are getting closer to the day of the final verdict. Less than a week from now, we will have the results of the general election 2024, an event we all have been waiting for as both citizens of this country as well as investors in the stock market. The past few sessions have been very good, with the market kind of rallying, perhaps because the market is already anticipating a very healthy electoral win for the BJP, among other factors. I'm Mahalakshmi, and I have with me a market veteran who needs absolutely no introduction, Sushil Kedia, to help you wade through the next few days and also to tell us about what he expects over the next 1 year once the election results are out, the dust settles and the new government is formed. Thank you so much, Sushil, for joining me on this discussion this morning.
Thank you for having me on your special show, Mahalakshmi ji.
All right. So, first thing that I want to ask you is obviously your sense of what are you picking up from media, other sources, from your charts and other analysis in terms of what is the market thinking about the outcome of the result. Purely going by performance, you would expect that the market is anticipating a very good electoral win.
Okay, so see, markets are not something outside our life. They are a part of our life. So within our lifetimes, this would perhaps be the first time, within our lifetimes, this would perhaps be the first time that an incumbent prime minister or his government are voted in third time in a row. This happened when our nation was formed initially, and after that initial formation, for somebody in a information-driven society as exists today, in this information overloaded society, a hyper-reactive society, a hyper-aware society, and after so many contests on the political front, to have this kind of a straight run. In fact, before 30 years, the period of 30 years before the present Prime Minister took over, India was known to be a nation of coalition governments. So 2014 brought in a very strong electoral statement from the people of India. They reinforced it in 2019. And now if this materializes in 2024, which by all means looks like BJP is going to at least gain, the BJP NDA ruling alliance is expected to gain seats over its 2019 performance. Nobody's any longer thumping the table on a 400 plus. So even with that, if they're going to gain seats over 2019, to me, the situation is similar to when Donald Bradman hit his third century. He did it even faster and even more strongly. So where, anti-incumbency sets in, boredom sets in, fatigue sets in, here is the government renewing its lease from the hopes, aspirations, and trust of people with an even greater vigor. So as this happens, my mind says, or what I say in life, I feel this is going to be a mandate of a Yug Purush. And with that, I think this government is going to get mentally and politically so strong that some very strong measures are to be taken, which is what the Prime Minister has gone on records stating. So post-election behavior is something different. And yes, handling this next 5-6 days, the way charts are already positioned, is going to be a totally different challenge.
So what do you mean by challenge? Because by what you're saying, if it's a strong electoral win, do you think the market will rally further? Because already you've seen, quite some anticipation and the prices have already moved up. So on Tuesday, when you see an outcome like this, would you expect that we'll touch a new high?
So the spread, how cunningly the market is positioned right now. The indices, both Nifty and Bank Nifty, appear to be having some strong resistances over here. Yesterday, Nifty kissed its tight resistance of 23,150, which is what we'd been anticipating for the last 3 weeks. And it made a reversal behavior yesterday. And today, no strength was really visible in the index. So maybe it can pull down through this week as we get to the final round of the emotional labor pain, so to say, if such a phrase is appropriate. And in that anxiety, a 400-500 pull down, points of pull down on Nifty can't be ruled out completely. It may not happen, it can happen. So until the breakout of 23,150 happens in the Nifty, prudence will not be to talk about 24,750. Though we've gone on record on your sister broadcasting channel, CNBC, Awaz, and other channels, while we were at 22,000, that will first go to 23,150, have some hesitation there, and eventually make that breakout towards almost getting close to 25,000. And I have that strong conviction, even though the Nifty chart does not provide a good basis to scream a move to 24,500 plus right away. But when you go to the devil, which is in the detail, and analyze the individual stock components, the way FMCG stocks are firing from a total laggard status to now catching serious momentum, and the way IT stocks have all started jostling up and are very likely at the beginning of a major uptrend, and the way the auto stocks are not relenting, a 5-10% correction comes in an individual stock, not the whole sector, or even the financial institutions, one by one something or the other comes into buoy up. Or if I can call the Reliance Group as a sector in itself and Adani as a sector in itself, both are looking exceptionally strong. So, it's the game of covariance compressions or covariance expansions for short-term option trading that market operators versus retail are creating this illusion that 23,150 cross nahi hoga. 400-500 पॉइंट की अगर हम बर्दाश्त रखें and we focus on the larger trend on stocks, there's a huge amount of money to be made through the next 1 year being the bull. Index is one thing and the money is in individual stocks.
So when you're talking about this pullback, you're talking about a pullback before Tuesday, and that
Right.
is that what you're saying?
Right. Any hesitations, any fears, any last pangs of disbelief, the disbeliever shall find temporary happiness in a 3-4 days pullback that could last up to Friday. Say, in any case, if the exit polls will come on Saturday,
Yeah.
which will with a huge dose of information asymmetry alter the entire trading texture for short-term traders on the coming Monday, and Tuesday the result will be out. So most people will be in a pressure, in a hurry to wrap up their short-term trading exposures by Friday.
Right.
So when any short-term leveraged traders, and our market is having one of the wildest trading volumes in the world. I think we are the single largest stock futures market for a long time, and now overall in stock derivatives too, the overall derivatives trading in a stock market, I think we are rated number 1. So with such kind of risk-taking prevalent widely from 1 lot to 100,000 lot traders, there will be a psychological pressure through this week. And if I can sense it, a small minnow in the game, the real big boys know that nerves can be pressed hard as we approach Friday. So perhaps, the reversal that happened yesterday can lead to a 300-400 points correction. And I think, the leverage has to get reduced to carry borrowed capital exposure into a major event. Either requires brain made of tungsten or requires intestines made of tungsten. I think most people lack tungsten in their body.
Understood. So, Sushil, if you were a trader, purely a trader, you don't have an investment portfolio, or you're not thinking about your investment portfolio, how do you play this next 1 week? And secondly, if you are a long-term investor, is there something you are, of course, you are a believer that this government will come back to power, but there is always in markets, there is an element of risk, right? You can't completely rule it out. Would you advise, to your mind, is there a way, would you advise people to hedge against any risk, or is this something we should be willing to ignore? So for both, an investor who has a longer term portfolio, but how should he perceive the risk over the next few days? And as a trader, how do you play it?
Okay, 4 or 5 questions we've bundled together. I'm glad you've given me, therefore, a pretty open canvas to talk and mix almost everything together. So let's handle this short-term beast first. Most of it I described already.
Yeah.
That there is an opportunity for those with deep pockets to press the nerves of the small traders through the next 4 or 5 days. So let it work out. If that happens, very short-term trading, index game is different. As I told you, we will continue to back a 1 month view, a 3 month view, a 6 month view, or a 12-month view, wherever available. See, if you have a choice of various securities, you also have a choice for what time frame you are going to choose your sensitivity. So in a narrow time frame of the next 4 or 5 days before this event, only people with tungsten in brain or in intestines should aspire to respond to the next 4 or 5 days. We don't have tungsten in either place, either in my guts or in my skull.
Right.
So I'm avoiding taking exposures that would require an alarming response into the very short term. So even as a leveraged trader, I'm not interested in playing the next 2 days down move or 2 days of flip up, but rather say if we are heavily betting on the mid cap IT stocks, most of which I think are going to go up 30 to 35% up. And before this, let me tell you one interesting statistic. Last 10 elections, I noted down the dates on a piece of paper and the date on which the results came. And I went back to load the Sensex chart for these 40 years. Except on one occasion, which is when in 2004, Vajpayee's government did not get voted back into power, India shining backfired.
Yeah.
It fell. On all other 9, whether Congress came into power or anybody came into power, or whether even it was a coalition government getting formed, it's a no-brainer trade, statistically speaking, that 15 days before the election outcomes, you get loaded onto the long side and stay on for another 15 days after the election results. 9 out of 10 times, somebody who did that has made money. I'll explain why this might be happening. And the only time that markets fell, that markets got disappointed, Vajpayee is not returning, the fall lasted only 3 days, even though it was a sharp one. And 3 days later, the bottom happened. And as Manmohan Singh ji came, so see, there are no permanent love affairs in business. And perhaps most of the time these days in society, perhaps, I should not comment deeply on it. There are no permanent love affairs in this world, but definitely in the world of business. So the markets will discover a new love. The underlying strength of India, the underlying strength of the fact that in etymological terms, इंडिया का टाइम आ चुका है. बाकी सारे वर्ल्ड की इकोनॉमीज, डेमोग्राफिक lopsidedness, the fatigue of consuming far more than producing, the record deficits, the total bankruptcies that central banks in the world are hiding under their carpets. So relatively, we Indians have done no such sins. So whatever configuration we get, there's a bare minimum good things that are going to happen to India. But on this merit of India, on this elephant of India that has been moving for a while, also get a Mahaut who seems to be proven, who seems to be liked, then the elephant will also, justle up a lot more in joy and start moving more rapidly. The confidence will not require adjustments. The change of will require adjustments. And markets do that pretty quickly. So you can say that whether you bought 15 days before the election results or you bought at any panic after the election results, 10 out of 10 times you made money. Why does this happen? This happens because the basic human nature at an individual level is to be perceiving more risk than exists. This is the philosophical basis on which all insurance companies make money. All insurance in the world is overpriced. People pay more for risk protection than the real risk exists. People in general have a tendency to be more cautious and more worried than what actually plays out in the world.
Right.
And the collective pessimism makes it rewarding for someone who's not going to participate in this pessimism. The human enterprise that has kept on marching for tens of thousands of years. Corona, the world crashed completely, right? And we called for a bottom on 25th March when lockdown came, purely from chart reading, because we have to suspend our subjective intellect.
Right.
We all have to be intelligent, but not succumb to our limited intellect. So with that sense, those who are selflessly, egolessly trading markets, they have made money in all the 10 last elections. And I'm dead sure you analyze this behavior in the prior 5 or 7 elections also. So the markets become underbought emotionally. So with that, if in the next 3-4 days I find any panic coming in and I find reversal patterns happening, I'm rather than allocating any significant risk exposure to indices that are far more complicated, and particularly around large events, they can be much more easily manipulated because of too much overexposure retail has. Stocks where I find a 3-month, 6-month, 12-month mega move. If a God sent panic comes in the next 3-4 days, any nervous reactions come into the market.
Right.
Those with cash in their pocket and discipline inside their heart, what better moments for you to buy them will come in. So I don't want to get into a theoretical conjecturization that this government may not work out. See, whether unofficial, official, there are sufficiently well-traded speculative markets that are pegging 315-17 seats for BJP and
Right.
therefore about 70 for the NDA. So that is going to be a whopping increment on top of the rising incremental performance we had in 2019. How many times in the history of the modern world you see for the 11th consecutive year, in the third term of a 5-year term, Indian governments are elected 5 years. That's the longest term anywhere in the world. I mean, have you seen a batsman in cricket who hits the ball far harder, faster, and pulls more runs while making his third century? Very few people have made third century. And somebody who made his second century faster than the first one, and the third one is going to make it even faster. That's why I label this, reinstatement of people's faith into Narendra Damodar Das Modi as a Yug Purush mandate. And allow me to show you an interesting chart here
Sure.
to tackle the return. I hope PCR is able to show this India government bonds 10-year yield chart, 10-year bond yield chart. I'm for putting a larger historical perspective, displaying the monthly data. So this crash of 2009 January, it happened when the stock markets had crashed. Okay, the crash of 2003 when people were crying कि जिंदगी में दोबारा stock market में नहीं जाएंगे, yields had crashed then. This crash in 2020 of the yields. So the popular notion that has arisen because all of us suffer the bad habit of worrying too much every night by looking at the US markets. The capacity utilization of an extremely developed economy like the United States of America is near saturation. And India is suffering from a conundrum of not having unlocked our capacity. We made toilets for everyone only after so many years of achieving the so-called freedom. Such a large population was living under the line of subsistence, not poverty. Not having a toilet is subhuman life. So the unlocking of the human potential and the amount of unlocking that is possible in India, the macroeconomics will obviously work a little differently here. Right? Even though, even in the developed economies, a dropping interest rate meant markets are dropping, economy is dropping. In our case, it's a much larger convexity that when economy is growing back, and why shouldn't it be this way? See, why should there be a dole to do well in life? When people are earning more, they spend on a bigger car, they move to a bigger apartment, either pay larger EMIs or pay larger rent. So if businesses, organized or otherwise, are doing very well, they should be happy to pay higher salaries. Wages should be rising. Rising wages is a sign of worry. It's a sign of capacity of the economy to pay better wages is there. Same way, interest rates are a rent on the capital. If an economy is doing well, धंधे में जान है, तो खर्चा बढ़ा के भी हम प्रोडक्शन बढ़ाएंगे. So what I am noticing that post these elections, let's come down to the weekly view for more clarity. Post elections, in celebration that bond prices are going up and stock prices are going up. So this ongoing correction in the bond yield since the top of 2022. And See the remarkable coincidence. It's not a coincidence, it's the actual econometric or economic explanation. Rates have been dwindling and running sideways. Stock price returns have also been running sideways. Big bull happened from the bottom of 2020 to 2022. And the rates have been languishing and the stock market has been broadly languishing. I see a ferocious rise in rates without going 0.9 all the way to 8.25, say about a year after the general election results are out. What if this is a Yug Purush mandate coming in? You will get a government bolder than ever. A government absolutely convinced with itself that it has the mandate to do everything right. So I expect very bold steps financially and economically also. Don't be surprised if all the long-term agendas of BJP in terms of the social equity that they have planned and deficit financing goes up. If that goes up, massive rural economic growth and the huge bet we have taken on FMCG stocks, I think sustain for a year. Or even the infrastructure bet, wherein the markets have run up a bit ahead of reality. So if a L&T goes to 3,900 post-elections in euphoria and then cools off 3,200, I'm just drawing a scenario. Maybe an L&T after 3,900 to 3,200 will form a new base, and we'll forget those prices of 2,500. और 3200 से L&T की तेजी 5,000 6,000 की अगले एक साल में बन जाए ना. Mad bull run in infra stocks comes after 1.5 months of correction. So your question about what a portfolio investor should be doing over the next, we obviously, with changing regimes, changing tones of the regulator, government, policy makers and business atmosphere obviously responds to those. We will need to rebalance and tilt our portfolios. And I think advanced warnings from the markets are coming in that with growing rates, maybe growing inflation too, if economy is going to heat up, a Yug Purush mandate can give the government to freedom to heat up things. And RBI on chasing the inflation targets because Yug Purush is heating up things. A matter like this, if you are not going to be boisterous and bold now, isn't this the best time for a politician to be boisterous and bold when he's voted in back with a growing number of seats for a third time? If not bold steps now, when? And those bold steps will make RBI chase inflation. So my thesis is inflation sensitive stocks like public sector banks or the rate sensitive stocks like public sector banks. See, we were notoriously bullish on public sector banks through 2020 to 2022 and then made a part last. Now we are completely getting out of them. I see a big bearish pattern on them. So the stocks that can pass on inflation, the infrastructure stocks where there's going to be huge demand pull, income growth, and in that atmosphere, perhaps risk sensitivity will be higher even though markets are going up. So earnings visibility may become a big theme again. And with US elections end of the year, and US policy makers are going to heat up their economy ahead of the elections. So if IT stocks go through the roof and where there's a convenience of earnings visibility, so our top 3 picks for the next 6 months to a year will be IT, FMCG, and infrastructure and cement on any pullbacks.
Right. So that's what I was good you concluded like that, because I was getting a little confused in terms of what you're saying. So you're not saying that there is a shift away from economy sensitives and infrastructure and all the sectors that have moved so far in the last 2-3 years. There is no shift away from that, but to the same set you are saying you're adding on consumption stuff like FMCG, which is already showing signs of momentum. But a lot of fundamental analysts still are not, at least the buy side people are not really comfortable investing in the sector, thinking that these are still very overvalued stocks. But you are saying that the next leg of policy move could actually spur a lot more consumption, which will probably lend legs to these sectors as well. Is that correct?
See, I want to use a different phrase than this wrong usage most people are making of economic sensitive stocks. Everything is sensitive to economy. All stocks are sensitive to the economy. What perhaps people are trying to mean, or maybe you are trying to mean, is interest rate sensitive stocks.
Fair enough.
So yes, we will be actively disowning and maybe even going short on NBFCs all of whom have had a poor history of interest rate risk management, should our call on the rate start working out. Muthoot or Mannapuram, despite such teji in gold and despite such teji in stock market, has still been languishing below their 5-year high. So things are not all right. Or a Cholamandalam or a Shriram Finance that have gone through the stratosphere, but still not showing signs that it is a sustainable uptrend. So I think shift away from weak financial stocks, PSU banks. Maybe we'll again buy into insurance as incomes grow, as bubbliness in the economy grows, people will buy more insurance. So barring few pockets of financial services, we will move money away from most of the financial stocks, and maybe at some point, maybe 3 months down the line after election results, autos would have made a final top, and it would be necessary to move money away from autos also. So
Okay.
that is why I said in simpler terms, earnings visibility convenience that will be offered by IT, FMCG, infrastructure and cement will remain safe bets. The other sectors will need to be perhaps traded out. That's my imagination for now, and I'm free to change it as market instructs me next 3 months.
Oh, absolutely. So, Sushil, you clearly said that in public sector banks, obviously, you're saying fundamentally also your prognosis is that interest rates will go up and therefore inflation will go up and interest rates will go up and therefore will not be good for public sector banks. You're also saying you're seeing that in the charts. How about private sector banks? I mean, fundamentally, if you see a lot of them are trading weak, at least the quality banks, are you seeing a different pattern there, or do they all fall into the same category?
The banks in general have run ahead of their performance. So if maybe PSU banks may suffer greater loss of investor confidence and private sector banks will suffer a lesser loss of investor confidence. But I don't see either private sector banks able to replicate the returns I can see happening in cement, infrastructure, IT, and FMC.
Sushil, one of the things that, I just met a fund manager just before this interview, just before this. And there are a lot of concerns fundamentally around, cement valuations, oversupply, capacities have gotten added over the last few years, which people think that will create some kind of pricing pressure going forward and so on. On the contrary, it's only in banks that people still find that there is a lot of valuation comfort. So how do you reconcile these two things?
I offer you what I believe. In markets, people have a choice to be either comfortable or to be profitable. So those who have a cushy mandate to manage other people's money, after finding the comfort of confirming quarterly results and backward numbers that get reported, all numbers that get reported they come with a lag. So I don't want to be sounding political while discussing different states of how things can be done in markets. This is our forward-looking view. What most people popularly discuss, markets have already priced all of that in. If huge infrastructure spending will come in, there will be a mad rush for buying into cement stocks.
Fair enough. You also talked about IT. What is is that what your charts are telling you? Do you also have an overlay of fundamentals that is being supportive? Because I'm sure you're also looking at US bond yields and the signals that are coming from US markets. So does that sort of obviate any kind of recession? Are the fears and risks associated with IT sector gone away now? What is your take?
See, there is a hypocrisy which is very prevalent widely into all stock markets of the world, that since big institutional money is supposed to run on fundamentals, there's a delusional tone with which people will say, oh, are you watching this on charts? Oh, is this a technical view? Well, those who read charts well understand one thing, that the collective wisdom of everyone, including those who are delusional about chart reading and those who are respectful of chart reading, everyone's opinion is captured well in the charts. And market as a final vector sum total of everybody's wisdom, wit, and wealth. Market is the final arbiter of everybody's intellect. Markets tend to run ahead of popular opinion. Smart money takes action first, and popular money takes action later. So the smart money bottoms out or tops out charts first, right? So if US elections are going to be a bet that US elections down the year, this year, will create certain policy innuendos from the Fed and others there that are going to create a heating up of the US economy. And that is going to, supply the required missing sentiment to the IT stocks. Your question is right. Is the fear on IT stocks over? If the fear would have been over, then where is the risk I am taking in buying IT stocks now? By the time the fear will be over, IT stocks would have been up 30%. So the bet we are taking is the fear in IT stocks will go away. When that fear will go away and everybody is comfortable, that is the time we'll be taking profits.
Sure. Sorry, I mean, I need to clarify. I mean, if I sounded disrespectful of chartists or technical analysts, absolutely not. I have utmost respect for technical analysts and definitely for you.
It was not at all aimed at you. In fact, in my 30-year-long career, there are only a handful of journalists who acquired your level of maturity and tact, that you are fair and balanced to everyone. And it's always a deep pleasure to interact with you on or off the camera. So, given that one is so comfortable with your stature as a senior journalist, I utilized your platform to point out at the general hypocrisy in the business.
Thank you, sir. So Sushil, what are your top bets? Of course, you mentioned a whole bunch of things, but anything that really stands out in terms of stocks or particular sectors, because you have a whole motley bunch of stocks and sectors that have done exceptionally well in the last round. And you are now including to that FMCG and IT. So the canvas only becomes bigger. And that makes, whether it is active fund managers or individual investors, it makes the job even more tougher. Or does it make it easier? You just throw darts and you make money.
So no, not at all throwing darts. Only those who are in ivory towers of academia, and where academic models are built with mindless assumptions, their models are beaten by monkeys throwing darts. But those who have acquired their education of making money on the street of hard knocks around Wall Street or Dalal Street, their methods cannot be matched by a monkey throwing darts or throwing anything. It is the academic assumptions and the lofty models that make forecasts which get beaten by monkeys throwing darts, not the practical street smart ways of doing things. So coming back, it's very clear. We are asking our clients to move their money continuously into IT, FMCG, and temporarily into media and entertainment stocks, and away from cyclicals. So we are taking a huge bet on accumulating chemical stocks. I'm not calling for a rocket kind of a move happening in them in the next 1 week or next 1 month, but over a 1 to 2 year horizon, I think the chemical stocks, despite the fact that they appear to be overvalued, is going to be a huge rebound in them, and most of them will go into significantly higher highs over the next 2 years. These are the 4 positive bets. We are very worried about the comfort zone with which everybody is keeping on singing in the financial space. One has to get very selective in retaining certain financials. Most of them, because of this interest rate debacle, everybody thinks, good government, good economy means interest rates down. Reality is the opposite of this. If there's a good government and economy is doing well, then why should investors who save money and postpone the gratification of consumption should keep suffering, and those who are spending on borrowed money should do it at a lesser rate? A fair economy and a fair balanced market where intervention is not creating an illusion of growth, but well-deserved and well-earned growth is coming. Rates will have to be going up. So we are very careful about interest rate sensitives. Careful does not mean kali bech denge. Maybe 1 month later we'll do.
Right.
But the idea is the theme of the financials that were gaining on a stable interest rate for the last 2 years. They will have to suddenly one day wake up and smell the coffee that rates have started going up. So there is more risk than rewards left within the NBFC space, almost all of them. Maybe an SBI card is an exception, but it's nothing to do with interest rates. It's a vehicle of payments and, a transaction mechanism, or,
Right.
few instruments. So out of financials and, metals, the global metal cycle is screaming at me. The charts are screaming at me loudly that copper may fall 30% or in aluminium may fall 30%. ठीक है 2025 में we will see again higher highs. But even on a 6 months to 1 year trading cycle, if metal stocks can create harakiri, so we've asked absolutely out of metal stocks and we are waiting eagerly, hungrily, desperately to find a sell signal to go short on them. So metals, cyclicals, and extremely overvalued manufacturing may have to pay way for these other stocks, and after manufacturing stocks their valuation cools off, maybe before Diwali we will get back into them. It's very simple.
Fair enough. Thank you so much, Sushil. I think one last question, which is, from now till Tuesday, what is your advice to a trader? You've already said that you will look at this as an opportunity to buy in case there is a, there is pullback, and that too in specific stocks, not in index. For those who still want to trade in the index because that's what they do on a daily basis, what are some of the do's and don'ts?
So I'll give you the answer I believe in. One, a trader needs no advice because a trader is somebody who has surrendered his mind completely and goes with the flow of the market, does what the market does. So I cannot advise a genuine, full-fledged trader. Those who are trying to do trading and have not had the mindset of surrendering their intellect completely and become the slaves of the market moves, for them, keep your position sizes smaller because the speed with which markets will move, or rather the speed of time inside markets, is going to be uh, much higher. Markets are going to move with a much faster speed, and keep your stop losses intact. But for those who are traders, a trader is someone who needs nobody's advice and he listens only to the market. So sorry traders, I can't offer you any advice. Those who are aspiring to be traders, keep position sizes small so that you can take stop losses. Otherwise, mentally you will not be able to do it. Be very nimble footed. And if you can't do both of these things, don't trade until the results are out.
On that note, thank you so much, Sushil. It is always such a pleasure talking to you. Thank you so much.
Entirely mine.